This is the second part of our risk and return session. It follows the first part where we take a look at general market risks. And in this part, we look more specifically at the firm-specific risk, the risk that's created by the decisions of individual managers when they're trying to run their companies. And this is defined by something that we call the beta. And our beta is essentially the measure of the risk of an asset within a large portfolio. And it's the contribution of risk of that one individual stock holding. It's a specific measure, essentially, of the covariance, or the difference in the rate at which the business's sensitivity to certain stimulus is going to change when the rest of the market changes. For example, if one company is very volatile, it goes up and down by 2 or 3% per day, while the market is only going up or down by 1%, then we'd say that there is a significant covariance, a significant increase in the covariance. And of course, this has to be standardized, so we compare it to the ordinary volatility of the market. And that's really the basic definition of our beta, the Greek letter B. It's the covariance of the stock relative to the market divided by the variance, or the volatility of the market. Or another way of saying that is it's equivalent to or equal to the correlation coefficient of the market times the standard deviation of the stock divided by the standard deviation of the market. It's a very complicated way of saying it, but essentially it's a measure of the relative volatility. Not the relative riskiness, the relative volatility. And I'll come back to that in a couple of minutes. Essentially, our portfolio includes all risky assets, and this is the relative risk of that particular one. It's our estimate of the beta will depend on the choice of the market, or the proxy that we're going to compare the company to. So if we're an average risky stock in a very volatile market, we'll look like a very safe stock. If we're a very safe stock in a highly volatile market, even more so. We started off in our previous session by taking a look at some of the different components of the risk. We said that a lot of the risk comes from things like interest rates, exchange rates, things that are going to affect the entire market. And we measure those by taking a look at the relative market rate of return. The market rate of return as compared to the risk-free rate. And we say that's our premium, or our market premium. That's the return that we require in order to invest in risky stocks. To invest in a particular stock, we're more concerned about the firm-specific risks, and those are the risks that are created by our decision to invest in certain products and markets, the decisions to compete in a certain sort of way, to own a lot of the value chain or own practically none of it. So those are firm-specific, and we also say idiosyncratic. And that's really what we're looking at in this part, the idiosyncratic risks. That's what the beta is a measure of. Essentially, the beta for an individual firm is the tendency of the stock to move up or down with the market. We estimate the beta by running a regression of the specific assets' returns, either their good days and their bad days, relative to those of that particular market, that particular index. That creates a slope line, and that slope line's slope is essentially the beta. That's the important coefficient that we're looking at. Like every other regression, we have regression lines that fit well and regression lines that fit badly. And so we also look at statistics like the R-squared. More of that in a couple of minutes. Normally, when we want to know what a beta is, we'll look it up. The best thing to do is just simply to Google your company, and you'll find that you get some very basic information from Morningstar, from MarketWatch. You can get the information from the NASDAQ index or the TSX index pages at tmx.com. And so we can get that information from those secondary sources. We can also see them quoted in brokers' reports, which is handy if you have access to information like that through your brokerage account, most likely. Historically, if MBA students wanted a beta, they had to go to the library and look in the beta book that was published on a quarterly, or I think it was 6 times a year basis, by a company called BERA. BERA still exists. It's part of another information company, and they still produce betas on a regular basis. They produce bespoke ones, specially created for certain situations. They produce predicted ones. The typical ones that we use are historical, based on historical information, and they provide information about leveraged and unleveraged betas, something we'll look at later in the course. Whenever using betas, make sure that you use the right exchange, because a beta for a company that's listed on several exchanges might actually be different depending on which proxy or index we're comparing it to. And we'll come back to that also in a couple of minutes. But you can calculate this yourself, and it's really not that hard. What follows is an example that I produced with one of my classes on another MBA program. In an all-day session, we were using the computers. We downloaded the information from the company's stock history, from the index's stock history, and we produced our own betas as part of an exercise. What you see on the screen represents the data that we needed. To start with, we had a total of 60 months, 5 years monthly data that was downloaded for Disney, for Walt Disney Corporation. And in column B, you can see we have a lot of numbers that represent the daily closing stock prices. In column D, we have got the change from one month to the next. So in the second month in our time series, it was $136 even a share. In the first month, really the last month of our time series, it was 133.6. So the difference between those two is 1.76% change. It fell by 1.76 from 136 to 133. So this is actually the time period leading from the most recent period going backwards. So all this column gives me, all of column B gives me the monthly change in the stock price from one month to the next for the last 60 months. This is a company that is listed on the Standard & Poor's 500 index, and so for the same periods, for the same months, we downloaded the Standard & Poor's 500 index numbers, and that's what the numbers in column E are. And so that information was downloaded, and I think we actually got this from Yahoo Finance. The percentage differences are exactly the same as we calculated in column D. So we just copy that information over here. So it's the end of period minus beginning of period divided by the beginning of period, and that's where we got the 1.61% increase in this one. Well, we did some other adjustments to lag and lead for time, and I won't go into those details as well, but that would give us a better or perhaps more reliable version of the beta. And with this information, we did the regression analysis, but we could also just calculate it by using a function called slope. You'll see the output from our work is presented on this slide. The raw beta for the company was 0.994. I think when we actually looked at the published beta, it was about 0.98. So we were really close to the number that was being published by companies like Bloomberg or used in brokers' reports. That beta, we also had done some adjustments by providing lagged and leading numbers just to see if we could smooth out the data, and that also came pretty close at about 1. When we plotted the numbers from our monthly returns on a scatter plot, we got the chart that you can see in this part of the slide. So for this part, what we see is the scatter plot that represents each month's performance for the index and for the stock, for Disney. Moving from left to right across the index, you can see we've got a scale from minus 10% to plus 10%, and that represents the returns to the index. So if you're over on the right-hand side, for example, if you're in this dot that we see in the corner, that on that particular month, and I don't know which month it was, but that represents that one monthly data point, we had a return to the index of about 10%, a really great month in the index. The stock also did pretty well. You can see on this scale, the stock was at about 14%. So this company did really well, did even better than the index on this particular month. In fact, if it would have fit on this line that we draw later, that would have been a perfect correlation. Some of these other months were not so good. For example, if we're over here in the bottom left-hand corner, you can see that the market was down by about 5 or 6%. And also the stock was down about 8 or 9%. So that was a different month, and that was that month's performance. Once we throw all of those dots onto our scatter plot, we use a trend line fitting procedure in Excel to give us this line. And the slope of that line is our beta. So in this case, there's about a 1-for-1 relationship. And that essentially says that's our beta. Now you can see that we don't perfectly fit. We've got some months that are way off the line, high and low. And that's the way the regression works. So our R-squared value is not perfect. We don't have a perfect relationship. We have some misfitting of the line. And that's going to be typical. Perhaps we end up with an R-squared as low as 0.3, which would not be unusual for this type of a regression. So yes, in fact, our R-squared, as you see from the diagnostics for our slope, was 0.32. So the relative volatility explains about 32% of the stock pricing performance. We can get that information from Bloomberg directly, and you can see they've even charted that for us. Bloomberg calculates numbers differently, so we'd want to look into how they've done it. But one thing I wanted to point out was that you can also have different betas depending on the index. For this particular company, BlackBerry, which used to be referred to as Research in Motion, and produces the BlackBerry software and used to produce the cell phones. If we are looking at them relative to the Toronto Stock Exchange, we see that they have got a calculated beta of about 1.45. That's the slope of the line. So we can see that the index from left to right across the bottom and BlackBerry from top to bottom, this line represents, or it actually solves the regression and tells us that we have a belief that this company is about 1.4 times as volatile as the Toronto Stock Exchange. Now, this company also has a listing on other indexes. For example, on NASDAQ, it looks a little bit different. We still have got the same upward sloping line, but you see our beta is only about 0.5. That's probably because the NASDAQ index is quite different than the Toronto Stock Exchange. The TSX is dominated by banking interests, perhaps some mining companies as well. Not so much in the way of technology companies. So relative to banking and other industrial businesses, BlackBerry looks quite volatile. Relative to the other technology companies that we typically see listed on NASDAQ, not so volatile at all. So depending on your purposes, make sure you're using the right beta, the beta from the correct index. You can see some other interesting examples of betas that I drew from a newspaper on one particular day, drew from one source on one day. In the Toronto Stock Exchange, you can see we have companies like Teck and Teck Resources, which is the Teck Cominco copper, silver, nickel, coal mining business that we have in BC. And they've got a beta of about 3.29. And that's definitely on the high side. And you can explain that because Teck is, even for a resource index like the Toronto Stock Exchange, is quite volatile. They produce copper, they produce coal. Those are things that go up and down with shifts in the market. They're very volatile. They tend to push themselves and the markets up and down. And also they have ties to other markets like China, which may also add some induced volatility to the stock. So if you're looking for action, this is a stock that goes up and down a lot. If the market goes up by 1%, we'd expect on a normal day Teck to fall by 3.2% or 3.3%. And it's exactly what happens. Not every day, but on average. Another company like gold mining company like Barrick, you'd think could be volatile, and it is. Gold and gold prices are volatile, but Barrick has a different source of volatility than the index. So its volatility does not correlate well with the index. quite often when index is having a really bad day, people are buying and holding gold because they're nervous about things like inflation, and gold is a good hedge against that. So they may buy gold mining companies. Gold mining companies might go up when the market's going down some of the time. So we have a low confidence, low beta for a company like Barrick Gold. And another company I like on this list, a really low beta, THI. No longer a publicly traded company on its own. This is Tim Hortons. Tim Hortons, of course, if you're having a bad day, if the market's crashed, you can still afford to buy donuts and a coffee. And for that reason, we find that this is one of the lower betas you're likely to find. That this company is actually might even be doing a little bit better when the markets are doing badly. There's some other companies in here worthy of mention. The banks typically have, like Bank of Montreal has a lower beta. Canfor is a company which is in the resource sector, also has a relatively high beta, perhaps a little bit lower now. And oil sands, again, it is looks like a low beta, but perhaps that's because the oil business also helps to move the Toronto Stock Exchange, so that would help us to have a lower beta. Now, you can see some of these companies also have a listing on the New York Stock Exchange, and the numbers are similar but a little bit different. And for example, Teck Resources, when they're playing on the Toronto market, they're among other resource producers. There are a lot fewer resource producers on the New York Stock Exchange. They're much more focused on industrial companies on the New York Stock Exchange. So Teck looks even more volatile relative to the New York Stock Exchange than it does to the TSX. Bank of Montreal has a listing on two markets. Perhaps some of this volatility comes from the foreign exchange differences, because they are a bank, and banks are relatively less volatile. And even among banks, Bank of Montreal would be considered quite stable, but its assets are denominated in dollars. As we go down the list as well, we can see some other companies that have also got low betas. Companies like Procter & Gamble, Colgate, Pfizer, Merck. Those are companies which are seen to be very stable in their nature. In fact, we call them defensive stocks because they tend to maintain their value even when the market is not doing well. If the economy is crashing, people are still going to buy shampoo and toilet paper, especially toilet paper. And so for that reason, they have a beta less than 1. In fact, as low as 0.5. The very last two of these examples are both something called ETFs, exchange traded funds. They've been set up by financial institutions. They are sold as stocks on the stock exchange, and they're traded just like stocks, but they track the index. So ISI is a version of a spider. It tracks the Standard & Poor's 500 index. So if the index goes up by 1%, they tend to go up by 1%. That's why their beta is close to 1. Not perfectly 1, because the New York Stock Exchange doesn't represent all of the S&P 500 companies, but it's pretty close to 1. XIC is a Standard & Poor's TSX index tracking fund, and that does have a beta of exactly 1. So in any day, I would expect my investment in XIC, an ETF that's marketed by a financial institution, to perfectly track the market. So an average stock would have a beta of about 1. That means the returns tend to move up and down on average exactly with the market. Not perfectly, but pretty close to. A beta greater than 1, higher level of volatility than the average. A safe stock, a beta less than 1, less volatile than the market. We'd say that betas are usually positive, although there are some examples, and on any given day I can usually find a few examples of negative betas, but they tend not to stay that way. Essentially that means that when the stock market goes up, they tend to have the opposite effect on their volatility. Now, one of the most important concepts that are introduced in this part of the course, we have the capital asset pricing model. Capital price asset pricing model, or CAPM, essentially describes the relationship between rate of return and risk. It's the rent that we charge on capital, and it's going to be different for every type of investment. It's the expected return on the market, and essentially it's made up of two parts, and we've already introduced these two parts. We have the risk-free component, or the essential cost of borrowing from the central bank, the risk-free rate, and the market risk premium. And that's the rate of return that we're going to earn on a riskier market-based stock, plus some kind of compensation for idiosyncratic risk. And all put together, that tells us that the expected return on our investment from a stock investment would equal the risk-free rate of return plus a market premium, that's R sub M minus R sub F, so that's the market premium. And we're going to multiply that by the coefficient that we learned about just now, the beta. So that particular formula essentially applies to all individual assets that are going to be held within well-diversified portfolios. So essentially our CAPM formula, which we were just introduced to, is the expected rate of return on an individual asset, which is equal to the risk-free rate plus the risk premium, and the risk premium itself is going to be the beta of the asset times the market risk premium. Essentially, it says that the expected return is going to be positively related to the security's beta. If beta was equal to 0, then essentially the required rate of return to our investment would be the risk-free rate, the rate on a government bond. If the beta is equal to 1, then the market premium is just going to be equal to our return from that investment plus the risk-free rate. You can see how that is going to be calculated. Remember back to when I spoke about the efficient frontier, and we talked about the security market line. Security market line essentially defines the relationship between risk and return. In this case, we have return as before on the left-hand axis, but here instead of having sigma across the bottom, we have beta, and beta becomes our measure of very specific, firm-specific idiosyncratic risk. So if we have a beta of 1.0 and we plug that into this formula, we start off with our baseline information about risk. The lowest possible return that we can have is the risk-free rate. We could put all of our money into government bonds, leave it there. The only thing we'd have to worry about would be inflation. That would be as close to risk-free as you get. If you put your money into a very low-risk stock, you're going to earn a fraction of the market premium. And if you put it into a stock with a beta of 1, you're going to earn the market premium, RM minus RF. And remember back to when we introduced the idea of RM, we get that by taking a look at the historical long-term returns to a stock market. So in this case, a beta of 1 indicates an expected rate of return of RF plus RM minus RF times 1. If we have a riskier stock, we have a beta of 1.5. We plug that information in, and let's say we have a risk-free rate of 3%. We have a market premium, a market rate of return rather, of 10%. Our market premium is going to be 10% minus the risk-free rate of 3%, or 7%. Our overall rate of return to our investment would be the risk-free rate, 3%, plus beta times 10 minus 3.7 would give us a total expected rate of return, or required rate of return, of 13.5%. So we brought together all of the different sources of risk. We have the market risk, the risk-free rate, and the measure of beta, the relative idiosyncratic risk. All those are together in one place. And that's what CAPM tells us, the rate of return to investment, or in this case, rate of return to equity. All these components of risks that we've just seen define what we've been talking about in this video and the earlier one. We said there are all kinds of risks. They're the market general risk, really, the things that affect everybody in the markets: interest rates, inflation, news about the economy, pandemics, exchange rate volatility, political risk, perhaps things like oil prices in the Canadian market. Those are things that affect everybody who trades on the same stock market. And so those are going to be measured by RM minus RF, the premium that we earn on top of the risk-free rate. Idiosyncratic risk, those are the risks that come from things like the projects that we invest in, the markets that we are expanding into, the decisions that managers make. And those things will determine the beta. Competition may be part of that. So we've brought together all of the different parts. The risk that everybody takes is the risk-free rate, the market premium, and the beta.